You know that feeling when a tax case starts out looking like a plain old money dispute, and then you realize it's a story about power, who controlled what, who did the work, and who got the benefit. That's the vibe here. The IRS first showed up with the income tax deficiency totaling approximately $746,000 across 5 years. Later, after amended pleadings and motion practice, the numbers in dispute swelled to approximately $1,291,000. That's an increase of approximately $545,000. And it sets the tone for what the case becomes. Not a misunderstanding, but a widening spotlight. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this kind of deep dive storytelling, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. In this video, we cover the tax court decision in the case of Vincent Fumo versus Commissioner of Internal Revenue, decided on September 24th, 2025. The opinion opens by making clear this isn't a clean slate dispute. The petitioner had been elected to Pennsylvania State Senate back in 1978, rose into leadership, and his Senate career ended after federal criminal charges followed by convictions on 137 counts in March of 2009, including fraud offenses and tax-related convictions for willfully aiding or assisting in filing false tax returns. The court frames the principal victim as two institutions, the Senate itself and a charity, Citizens Alliance for Better Neighborhoods, which had tax-exempt status under sections 501c3. And this is where the story turns into something almost cinematic. The petitioner is never described as an officer or employee of the charity, but the court documents him essentially narrating his own influence. At his criminal trial, he admitted, "I don't have a title or a job. Do I have influence? Yes." Then he went further. "I viewed it as my nonprofit. I viewed it as my entity, my baby." The prosecutor even reads him the Form 990 instructions definition of a disqualified person, and the petitioner replied flatly, "I did have substantial influence over the organization, so according to that, I am a disqualified person." Once the criminal case does settle, the IRS came in with two parallel civil examinations. One for income tax, the question being what unreported income did the petitioner receive, and one for excise tax under Section 4958, aimed at excess benefit transaction involving charities and disqualified persons. The opinion makes a point of saying the IRS teams leaned heavily on FBI compiled evidence that had been introduced in the criminal case. The court's factual narrative paints a world where the boundaries between official, political, and personal weren't just blurry, they were treated like optional. The petitioner had multiple properties and vacation routines, and staff presence followed him into those spaces. The opinion describes a Philadelphia residence that staff were constantly in and out of, handling errands, contractor access, technology issues, even labeling all the light switches in a 3-floor home. It describes beach properties used for weekly barbecues and large parties, with supplies purchased at big box stores and charged to the charity. It describes a farm property near Harrisburg that required renovations and heavy equipment, plus staff time, again drawing on the charity's assets and the Senate payroll. Then comes the subplot that frankly reads like a techno-thriller footnote in a tax opinion. As the petitioner became worried about FBI investigation, he pushed wiping programs across staff devices. The opinion contrasts ordinary deletion with programs that permanently remove data, and it includes the colorful description of certain wipes as the mother of all wipes. The court later notes the practical consequences. Very few email messages were recovered because of extensive wiping activity ordered by petitioner. This matters because the civil case becomes a reconstruction story. Agents and revenue officers rebuilding economic reality from vendors, contracts, invoices, mileage, and testimonies. So what did the IRS say happened in plain story terms? That the petitioner extracted taxable benefits from two fountains: Senate paid labor and charity paid staff and services. For the Senate side, the IRS claimed roughly $2,863,000 of taxable benefits over years 2001 through 2005, driven by three themes: inflated salaries engineered for loyal staff, staff time devoted to personal and political tasks, and contractors paid by the Senate who worked largely for the petitioner personally or politically. For the charity side, the IRS alleged benefits totaling roughly $726,000 over years 2001 through 2004. Tools, consumer goods, vehicles, farm equipment, staff services, political polling, and more. The court's income analysis is basically a repeated lesson in one phrase it uses: control and benefit. It leans on the idea that income isn't limited to cold cash, and that a person can be taxable not only on what they receive directly, but on what they cause to be diverted to objects of their bounty. In other words, if you can aim the money and you aim it to serve you, tax law can treat that as your income. On Senate salary, the court finds the petitioner falsely certified inflated salary for 8 employees and concludes the excess amount of about $1,010,000 in total were includable in his gross income because he exercised dominion and control over the diversion of those funds. The petitioner's defense theme was that this wasn't money in his pocket, at most political capital. The court's response is sharp. It says he gained more than political capital, including unquestioning loyalty, compliance with personal service demand, and even that he bought their silence. Then the opinion does something that makes the story feel granular. It estimates how much staff time was diverted into personal and political tasks by role, using testimony and evidence. The court ends up finding that Senate staff services produced total unreported income to the petitioner of approximately $1,490,000 during years 2001 through 2005, with about $480,000 of that being time-based allocations beyond the salary overpayments. Next, it turns to Senate contractors, some allegedly doing little legislative work and some described as ghost contractors doing none. The court applies allocations and for multiple contractors includes 100% of compensation as income to the petitioner where the contractor did no Senate work or effectively none. It determines additional inclusions from contractor payment totaling roughly $1,074,000. Now we move to the charity, the place where the opinions, how did this get paid, details becomes almost darkly mundane. It's not one dramatic transaction. It's lots of smaller ones. Tools ordered online and shipped to personal locations, party supplies, personal items, vehicle usage, staff hauling services, and heavy equipment on private farm. For tools alone, the IRS reconstructed purchases and the court sustained inclusions totaling roughly $66,000 for years 2001 through 2004. The petitioner even considered the aggregate tool cost was taxable income to him. The consumer goods, the court sustained inclusions totaling of about $24,000, describing the charity-funded shopping that included everything from groceries for summer parties to items like vacuum cleaners and hairspray. The farm chapter gets especially pointed. The opinion describes a bulldozer boat for about $27,000, later repaid for about $17,000 $1,000 plus other equipment moved to or kept at the farm. The court rejects the notion this was casual borrowing with a line that feels like it belongs on a t-shirt. In the real world, one does not borrow heavy-duty construction equipment, one rents it. Vehicles get the objects of bounty treatment too. The court concludes the petitioner must include the value derived not only by him but by staff, consultants, and allies from use of certain vehicles, and it sustains the total inclusion of approximately $117,000 across several years. Even the charity's staff labor becomes income when it's used for personal hauling, long-distance trash pickup from the shore, and similar tasks. The court sustains inclusions totaling roughly $8,000 for that category. And that's just the income tax side of the charity story. There is also the excise tax story, where the question becomes, was the petitioner a disqualified person and did he receive excess benefits from a charity without proper contemporary substantiation as compensation? The court explains that the charity did not report these benefits as compensation and in some years didn't even file a return. It also notes the petitioner had no employment contract with the charity and provided no documentation showing intent to treat these benefits as pay. In plain English, you can't retroactively relabel the perks as compensation to dodge the tax, especially without the paperwork the rules demand. The petitioner's move is consistent. A lot of this, he says, was too indirect, just political capital or community benefit or staff efficiency. The court calls that out as basically the same too amorphous argument it already rejected on the income side, and it holds he is liable for the 25% first-tier excise tax on about $484,000 of excess benefits. If you compare the court found excess benefit figure to the IRS earlier alleged charity benefit totaling roughly $726,000, the gap is about $242,000. A big reminder that even in harsh opinion, the court is still doing arithmetics carefully, category by category, instead of rubber stamping every allegation. Then comes the penalties, the part of the story where the court stops describing what happened and starts describing what it thinks the petitioner intended. On the civil fraud penalty, the opinion recites the badges of fraud framework and concludes that numerous badges of fraud show that he acted with fraudulent intent during 2001 through 2005. It points to a pattern of substantial understatements, inadequate records, and importantly, active destruction of documents through the wiping program. It also focuses on what he did and didn't tell preparers. He gave his return preparers no information about benefits misappropriated from the Senate and the charity, and it highlights false information given to the charity's accountants about political polling, including that it was framed as neighborhood questions. The court even notes the petitioner was convicted of aiding in filing a false charity return for 1 year, tying the civil fraud analysis back to established criminal findings. Finally, there is the excise tax failure to file add-on. The petitioner argued he didn't know about the Form 4720 filing obligation and didn't understand terms like disqualified person. The court is blunt. It calls Form 4720 an exotic species, but says the petitioner was a highly sophisticated actor and that the basic rule for public charities is that the expenditures must serve a charitable, not private purpose. It points out that during 2002 through 2004, he caused the charity to pay more than $100,000 for tools, food and beverages, heavy equipment and vehicles tied to his use, and more than about $250,000 for political polling he knew was improper, as shown by efforts to mislead accountants. The punchline is a classic. Ignorance of the law does not amount to reasonable cause. And the ending is procedural but telling. Decisions will be entered under Rule 155. In normal person language, that means the court has decided the substantive issues and the parties will compute the exact final number in follow-on process. So what's the takeaway? In the slightly satirical tone this case earns, if you spend years treating two institutions, the public payroll and a public charity, as your personal Swiss Army knife, don't be shocked when the tax court treats political capital like what it often really is, a paid for benefit with a price tag. And if your response to an investigation is to order the mother of all wipes, it's hard to later sell the court on, I had no inkling. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. And if you like this video, please give it a thumbs up and subscribe to this channel. And I'll see you in the next tax court case review.